Welcome to the deep dive. Today, we're taking a closer look at a real American icon, Ford Motor Company, ticker symbol F. And whether you're maybe thinking about buying a new car or perhaps looking at it from an investment angle, our goal here is to really distill the latest thinking, the newest data surrounding Ford. We've been digging into recent market analysis, investment commentary, that sort of thing. And what really jumped out, I think, is this interesting tension. On the surface, Ford can look like a really compelling opportunity. But, well, the deeper you look, the more these significant risks start to pop up. So, okay, let's unpack this. All right, so let's start with what seems like, the obvious good deal part for Ford stock. First off, there's that dividend yield. It's impressive, currently sitting at 5.05%. That's quite a return in today's market. Finding solid income like that isn't always easy. And then you look at the valuation, the price to earnings multiple, the PE, it's only 10. Right. For anyone less familiar, that basically tells you what investors are paying for each dollar of Ford's earnings. Compare that to the S&P 500 index average, which is, around 29. So on paper, Ford looks, like a bargain, right? Mm-hmm. Definitely catches your eye.
Yeah.
It does. It absolutely does. But those numbers, compelling as they are, they don't quite paint the full picture, do they?
Yeah.
Let's peel back another layer here and look at maybe some of the storm clouds. Because that initial appeal, it gets complicated pretty quickly when you factor in the wider economic, political environment. There's just a lot of uncertainty hanging over the auto industry right now. A big piece of that is President Trump's auto tariffs, introduced back in April. And for Ford, this isn't just some abstract thing. It's got direct financial bite. Management has explicitly stated an adverse adjusted impact of $1.5 billion on earnings this year.
Wow. Billion.
Yeah, $1.5 billion. And the reason's pretty straightforward. About 17% of their North American production is actually in Mexico and Canada. So they're right in the line of fire for these tariffs. What's maybe even more telling is that Ford's management actually pulled their full-year earnings and revenue guidance, citing, and this is their term, tariff-related uncertainty.
Pulled the guidance completely. Which means the company itself isn't really giving investors a clear map of what to expect. Makes the future very, very murky.
Okay, so it's not just impacting the company's financials directly, it's also hitting the consumer side, right?
Yeah.
I mean, the ripples from this uncertainty, they're reaching car buyers, too.
Yeah.
We saw maybe that initial little rush when tariffs were first announced. Maybe people worried prices would jump. But now, consumer surveys seem to show people are getting more cautious. Worried about the economy, holding off on big-ticket items like cars. And Ford sees this, obviously. They've been pretty aggressive with incentives, remember the employee pricing deals, and now they've got this 000 summer incentive program running, which means $0 down, 0% interest for 48 months, and no payments for 90 days.
Right.
That's a big push to get people into showrooms.
It absolutely is. And it raises this important question, doesn't it? About the broader economic mood, about consumer psychology. That caution you mentioned, it ties right into the bigger economic picture. I mean, sure, some economists are maybe a bit less pessimistic than they were, but you still see figures like maybe a 40% chance of recession over the next year cited by some.
Still pretty high.
It is. So even with these really tempting deals, buyers might just be thinking, let's wait and see. Wait for the tariff situation to clear up, or wait for the economy to feel a bit more solid before making such a big commitment. You have to wonder if these incentives are actually drumming up new demand or just, pulling sales forward from future months, which could leave a gap later on.
Right, a potential sales vacuum down the line. Okay, so what does all this mean for someone looking at Ford, maybe longer term, for the stock, for the business itself? Because when you zoom out, look at the last decade, the numbers are kind of sobering. Ford's stock, it's actually down 17% over 10 years.
Down 17%.
Yeah. And meanwhile, the S&P 500, just tracking the big U.S. companies, that soared more than 200% in the same time frame.
Mm-hmm.
That's a massive difference.
It is. And honestly, that kind of underperformance, it's maybe not entirely surprising when you think about it. These huge established automakers like Ford, they often struggle with what the analysis calls slow changes, a sluggish pace of innovation.
Right, turning the big ship.
Exactly. It's not necessarily a lack of trying, but it's just the sheer inertia. Decades of existing factories, supply chains, complex labor agreements. It all means they just can't pivot like a newer tech company might.
And then there's the whole electric vehicle, the EV segment. There was that big surge in interest a couple of years back.
Yeah, I remember that.
But Ford stock gave up all those gains. And their EV future, well, it looks, frankly, a bit unstable right now. I mean, look at the first quarter results. The EV segment lost $849 million.
Ouch. Still losing that much. still deep in the red. And that puts enormous pressure on them, right? How do you fund the next generation of EVs? How do you scale up production when the current operation is bleeding cash like that? It potentially forces some really hard choices between propping up the profitable traditional truck and SUV business
Yeah.
and investing aggressively in EVs. And add to that, the federal government just cut some of those EV tax credit incentives. That makes EVs less attractive for buyers.
Another headwind.
Exactly. And then you've got these ongoing battles with states over who pays for charging infrastructure, which is, absolutely crucial if EVs are going to take off widely. So you put it all together, the internal losses, fewer incentives, infrastructure bottlenecks. It really feels like there isn't a major positive catalyst right on the horizon for Ford stock. Based purely on that historical track record, a simple S&P 500 ETF might look like a more reliable bet.
So let's try and tie a bow on this deep dive into Ford. It really is a fascinating picture, isn't it? This difference between market perception and maybe the underlying reality. On one side, yeah, you've got this company, looks good at first glance, that dividend is nice, the valuation seems low. But then as we've sort of dug into, you see these pretty significant headwinds, the tariffs hitting the bottom line, consumers getting nervous and maybe pausing purchases, and these longer-term questions about innovation speed in a tough industry, especially around that crucial EV segment, which is, well, facing its own set of pretty big hurdles right now. It's quite the balancing act.
It really is. And I think what Ford's situation really highlights is that delicate dance between how a company looks in the short term, the perceived value, and those bigger long-term industry shifts, the economic uncertainties that can totally reshape things. So maybe the question for you, the listener, is how does looking at a case like Ford help you think about the real risks and opportunities, not just in cars, but in any complex market you're analyzing? It's a good reminder, isn't it, that the numbers on the screen are just one piece of a much larger puzzle.